get some insights and news shaping the markets. For that, we welcome in Michael Reinking is with us, Senior Market Strategist here at the New York Stock Exchange. Thanks for being with us. What are people saying about 2024 thus far?
Well, I mean, thus far it's been a pretty choppy year, right? And we've, kind of the S&P 500 has basically been kind of trading on either side of unchanged. But you put that in perspective, we had that very significant rally at the end of last year, and the index has been in a 100-point range really since the middle of December, the day following the Fed meeting between 4,700 and 4,800, and we're testing that all-time high today, right around 4,800. And to make it even a little bit more interesting, today is an options expiration as well, right? So the question is, do we start to see kind of a push through that level, kind of as we head into the close, or do we kind of get pinned right here, at that strike price?
Yeah, I mean, I think a lot of people are watching that 4,800 level to break out. You're hitting some new highs. And what are the catalysts and the fundamentals for these new highs? And when we look at earnings, are they good enough to continue to drive things higher in the year to come?
Yes, and so, taking a look at the earnings picture, we've seen some pretty big revisions, since the end of Q3. So analysts were looking for year-over-year earnings to be up about 8% for the S&P 500. At the end of September, that's moved down to about 2%. As we head into the reporting cycle, that once again kind of lowers the bar for companies to kind of beat that bottom line.
That's a big change.
Yes, that is a very big change.
8% to 7%, would be a change.
Yeah, that's
8% to 2% is a huge change.
Kind of 2 to 3 times like historical averages. So once again, that sort of lowers the bar for companies to beat, kind of this quarter. But markets are pretty desensitized to that, right? There's a much more focus, on the 2024, kind of commentary and numbers, and actually, in some of the recent reports that we've gotten this week, there's been some reasonably, kind of cautiously optimistic commentary. You guys have talked about kind of the semiconductor space. We had Taiwan Semi, give us some really positive commentary. Even some of the industrials that we had heard from, kind of last night and this morning had pointed to some positive linearity in the quarter, right, and suggesting that they're starting to see potentially a turn as we kind of move to the back half of this year. So, suggesting, especially within kind of the transportation sector, suggesting that we could be nearing the end of this destocking cycle and moving into kind of a restocking cycle, which would actually be pretty positive from kind of an economic perspective.
So, as you say, the economic perspective and the uncertainty that is sort of underlying, because you'll get a piece of good news, a piece of bad news. There's inflation, there's no inflation. The Empire manufacturing number, you could say it was a one-off, but that was terrible. We got existing home sales today showing that was to the downside, right? In your key topics, you have economic uncertainty, margins, cost cutting, and inventories. Tell me about some of these themes that are sort of circulating in your mind.
Yeah, I mean, as you just pointed out, I think one of the most confusing things for kind of markets over the last year has just been the cross currents that we're seeing in terms of economic data, right? If you look at the soft survey data, like the Empire that you pointed out, the Fed's Beige Book, right? That's pointing to a much kind of weaker, and more slowing of an economy than we're seeing in kind of the government headline data, like the non-farm payrolls and retail sales. One of the things that we'd seen early in the reporting cycle in terms of earnings is that we were starting to finally see companies see a little bit of demand weakness, so some top line weakness, right? If you think back over the past year, they've been able to raise price and to help kind of grow revenues as the inflationary backdrop has started to shift a little bit. They're having a little bit of a harder time doing that. Right, and so we're starting to see a little bit of weakness on that front, but what we are seeing is that companies have focused on cost cutting and efficiency gains, so they've been able to hold that bottom line, right? And I think the key, right, to the linchpin to all of this, once again, from my perspective, goes back to the labor market, right? So if we don't see companies, kind of widely cutting headcount, right, then you'll see the labor market continue to hold up, and the consumer can remain resilient. And as we saw in this morning's kind of consumer sentiment, right, we're starting to see consumer sentiment actually improve a little bit, right? So that could suggest that we could continue to see, a resilient, consumer going forward, and the economy can kind of potentially pull off the soft landing that everybody's kind of hoping for.
And so then what do you tell folks when you try to give them some actionable advice about the strategy about how to handle a market like this one?
Yeah, and it's a very difficult market because the price action tells you something different than like when you kind of go through all of the negative headlines that are out there. I think this year, right, there's going to be a lot of volatility, right? So while I do think we're going to end the year higher, I think there's going to be some point in this year where you're going to see kind of a growth scare or an inflation scare, and that'll give you kind of the opportunity, right, to kind of get involved, right, if you're not already involved in the market, or kind of tactically get a little bit more aggressive. Right here in the very near term, right, I mean, the chart patterns look really good, right, and it's hard to kind of argue with kind of the price action, right? So it does seem like we're going to kind of try to make a push through this 4,800 level in the S&P. We continue to see the weakness and some of the thematics that we'd seen last year with the underperformance of kind of small and mid-cap companies, as they still kind of are, you have about half of the companies in the Russell 2000 have negative earnings, and they're much more exposed to kind of the interest rate environment.
Right. Yeah, and that's part of it too, because there's just all that uncertainty pertaining to the interest rate environment. I don't think anybody expected to see rates jump up the way they did this week. Right? I mean, when you're seeing the 10-year at 4.16 or something today. Good to see you, Michael Reinking. Thank you so much, of the New York Stock Exchange, market strategist there. Thank you very much.